Hey everybody, and welcome to the last video on derivatives. And in today's video, we are going to be talking about swaps. And I know that swaps are possibly the most obscure or least talked about of the derivative instruments that we're talking about in this unit, but we're going to go through them carefully because of that, because they are super important. So we're going to go through three different kinds of swaps, and then we're going to close with a discussion on specifically credit default swaps and their role in the financial crisis. So, you may have heard them mentioned maybe one or two times, maybe in The Big Short, but you may not know what a swap is. And it's just an agreement between two or more counterparties to exchange a set of cash flows over some future period. And there's three major types of swaps: interest rate swaps, currency and credit swaps, and then finally credit default swaps. And we're going to talk about each one. So, first with the most simple, the interest rate swap. This is just a contract under which counterparties agree to swap interest payments over a specific period on a fixed dollar amount. And we call that fixed dollar amount the notional principal. Now, it's really important to understand with these interest rate swaps that usually one party is going to typically pay a fixed interest rate while the counterparty pays interest on a floating rate used, and that floating rate used to be based off of the London Interbank Offered Rate, or LIBOR. However, this is going to quickly become outdated because by the end of 2021, LIBOR is actually going to get phased out. So that's why I have it underlined, is because, if somebody were to take this class like next year, this would no longer be true. But that was a lot of terminology. So we're going to use this simple example to kind of break down what I was talking about. So let's look at a sample interest rate swap between Wells Fargo and IBM. And we're going to say that Wells Fargo and IBM agree on a swap lasting 5 years on a $10 million notional principal. And in this interest rate swap, IBM is going to pay Wells Fargo 6% annually. So for 5 years, IBM is giving Wells Fargo 6% interest, or $600,000. Meanwhile, Wells Fargo is going to pay IBM based on the current LIBOR plus 4%. So let's just say in year one that the LIBOR is at 3%. Then that would mean that IBM owes Wells Fargo an interest stream of $600,000, whereas Wells Fargo is going to owe IBM $700,000. Therefore, in the net with the interest rate swap, Wells Fargo is going to pay IBM $100,000 in year one. And you're like, well, Wells Fargo just lost a lot of money on this. If this keeps up for 5 years, they're paying $100,000 for 5 years. Well, the biggest reason to enter into an interest rate swap is to transfer interest risk between parties. So, we've talked about interest rate risk between, investors in like bonds and the stock market over time, but it's not equal between all market participants. So, for example, Wells Fargo, their main source of cash flow is interest, right? And so when interest rates are low, they don't get a lot of cash flow. However, when interest rates are high, they do. So they have a lot of volatility in their cash flow just based off of interest rate, which, for the most part, there is kind of out of their control. And it's not like they can diversify their portfolio too much, since Wells Fargo, a lot of what they do is, lend out to commercial companies and individuals and households. Whereas IBM, their cash flows from selling IBM machines and et cetera, and Intel. Uh, so they don't really care about interest rate fluctuations. Furthermore, what interest cash flow they do get is usually fixed and predetermined, and there's low probability of default. So, in the short term, IBM can transfer some of that fixed income to Wells Fargo, and in response, Wells Fargo gets to offload some of their interest rate risk by entering into this interest rate swap. And that's what this first point is saying, is that this interest rate swap allows the transfer of interest between parties. So, in the short term, they're basically paying IBM to take on some of Wells Fargo's interest rate risk so that, like, let's say the LIBOR plummets to near zero, then they would actually net profit $200,000 in that year that the LIBOR was near zero. So, it really is just a redistribution of floating versus fixed interest payments. Additionally, as a bit of a secondary advantage of swaps besides redistributing interest rate risk, they're also extremely flexible to meet the needs of the counterparties. And one of the big reasons for that is they have very little government regulation. So that means that they can last a really long time. And that means that, if Wells Fargo in the long term is scared about their long term risk from interest rates, then they may want to go into a 20-year swap contract with IBM and vice versa. So they're very flexible instruments, and it, as I mentioned, it is a way, specifically with interest rate swaps, to hedge against risk from your principal business. And we're going to get a little bit more into that with credit swaps. But another two types of swaps that are kind of similar are currency and credit swaps. And currency swap is just a contract in which the counterparty agrees to exchange principal amounts denominated in different currencies. So let's use a simple example. And we're going to talk more about currency in the Forex market in the next chapter. But for now, we know that currencies aren't always valued the same, right? When you weigh currencies compared to each other, sometimes they'll go up and sometimes they'll go down. And based off of where a company is located, they may have certain operating advantages in certain currencies. So, for example, Volkswagen, it's a German car company and it operates out of Germany, so it has a competitive advantage over operating in the euro. However, a lot of their sales are out here in the US. That makes them uh, particularly vulnerable to changes in the euro because their income is being valued in the euro. So if the US dollar loses its value compared to the euro, then Volkswagen's operating profit will look comparatively poor compared to their competitors. Whereas Ford is, basically the opposite. They have an operating advantage here in the US. So these two companies may go into a currency swap where they basically exchange based off of some fixed exchange rate. They will exchange their currency streams for a set period of time in the currency swap to protect themselves from currency risk based off of exchange rate changes. And like I said, we'll get a little bit more into exchange rate changes later on, but just know that it is important to protect yourself against potential changes in currency exchange rates when operating multinationally. And then additionally, credit swaps are kind of once again a similar idea where you're just offloading risk and having risk sharing within the greater economy. So let's use like a simple example. A credit swap is just a contract in which interest payments are exchanged with the intention of reducing default risk. So they're different from interest swaps because they're not usually based off of a fixed rate versus a floating rate. It's literally just flat out exchanging interest rate or interest streams. So, for example, with regional banks, like I'm from a small town in Wyoming, that means that all local banks based there are basically lending out to natural resource extraction. In my local economy, we have oil extraction, gas extraction, coal extraction, the big three. So what happens if the fossil fuel market starts to decline? Well, that bank that is loaning to these, regional and local businesses is all of a sudden extremely vulnerable to default risk. On the flip side, you may look at a small bank in Indiana where basically all it lends out to are farmers and farm related individuals. So if there's a bad agricultural season, that bank is at risk of default because of the interest rates, the interest not coming in. So what these two local banks can do is they can do a credit swap on part of their interest stream so that if that my bank in Wyoming sees a decline in fossil fuels, they'll still get the interest stream from the farms in Indiana. And in the flip side, if there's a bad agriculture season in Indiana, then the local bank will still get the interest stream from the oil and gas companies in Wyoming. So it's just, again, another way to mitigate risk. Now, the final one is probably the swap type that you've heard referenced to the most, which is the credit default swap or CDS. And in a credit default swap, it requires that the seller make payments to the buyer if the price of some underlying security declines in value. And it can go two ways. It can either act as a type of insurance or to speculate. So it can act as a type of insurance in the sense that if I own, US Treasury bonds, if the price of the Treasury bond goes up, then it's more valuable to me. But if it goes down, then I lose value on it. So I can buy a credit default swap to then receive some sort of revenue stream based off of my hedged bet against the value of the US Treasury bonds. However, they can be used, as I mentioned, to speculate as well, because you can also take the same side in the credit default swap as the underlying. And these became really important in the financial crisis because uh, credit default swaps sold on collateralized debt obligations, which I'll get into in a second, were one of the main drivers for just the severity of the financial collapse. And what is a CDO? You have to ask. And a CDO is just one of the most complicated derivatives that you'll ever hear of. So all that you need to really know about them for this class is that they derive their value from the interest payments coming from mortgage-backed securities, and they're layered together so you have different levels of CDOs called tranches based off of the value of the underlying mortgage-backed security and the perceived strength of it. And what ended up happening was the investment banks that own these CDOs could either buy or sell CDSs, credit default swaps, to invest in. And they would buy them to get insurance from the CDO losing value, or you could take the opposite side to double dip on the CDO to get even more cash flow if the CDO gained value. And as I mentioned, this was a big problem in the housing market. All these big, massive investment banks thought that there was no way that the underlying CDS or the underlying MBSs and CDOs could go into default. And so they started to speculate heavily, heavily, heavily on the CDOs. And the reason for that is because the housing market started to dry up, right? In 2005, 2 years before the financial collapse happened, we started to see the housing bubble burst. And so just the flow of mortgages entering into new mortgage-backed securities dried up. So these investment banks got greedy and they said, well, we can't buy more MBSs or CDOs, so we are going to enter into CDSs so that we can make even more money from the interest stream. So they were speculating heavily on an underlying that really meant that they were way more exposed on one underlying asset than what most financial regulators realized. And so what ended up happening was a lot of these MBSs and CDSs were issued by one specific company called AIG, which stands for American International Group. And all that they are is a giant insurance company that underwrites a ton of different financial asset issuances, and they act as an underwriter in the event of default, and in exchange they get paid to underwrite. So they make a ton of money, but on the side they started issuing a massive number of CDSs, and they started underwriting these CDSs whimsically and liberally. And really, they massively underestimated the risk that the CDSs pose. They didn't realize that the CDSs weren't just being sold as insurance, but also as speculation. And they even took in their fair share of speculation in the CDS market. And what happened is, as the bubble burst, they had insufficient collateral to pay off the CDS payments as the underlying assets started to decline in value. And so, just like investment banks like Lehman Brothers that we talked about, AIG was pushed nearly to the edge of bankruptcy. The big difference with AIG with other these investment banks is that if AIG went under, then our entire financial system would effectively have no insurance. They were estimated at one point to insure up to 75% of all private financial assets. So think about just like 75% of the economy in the world just no longer have insurance as the entire system falls apart. We're talking about a huge problem that just surpasses tremendously the risks posed by Lehman Brothers going under. And so the US Treasury Department and Fed together bought an 80% stake in AIG for $85 billion, which meant that we were transferring basically this private ownership of risk into the US federal government to help level out fears of the entire financial system becoming uninsured in the middle of the worst financial crisis since the Great Depression. But the weird thing is that that meant that one of the biggest private market players was the US federal government. And so as things stabilized, the government quickly unwound their investment in AIG and returned it back to the private sector, but without a little bit of a silver lining. The US government actually made $22 billion on its AIG investment, which is an ROI of nearly 25%. So, a little bit of silver lining, nearly disastrous. A lot of people don't realize that AIG and these CDSs really were one of the biggest threats in the financial crisis. But as I mentioned, happy ending, and hopefully we don't have to deal with something like that again. That being said, you are finished with the derivatives chapter, and you can take the chapter 7 quiz.